People have not stopped asking me to give a breakdown of Douglas Elliman's Q4 earnings call. I'm going to break it all down for you. I've done it for EXP, Real. We're going all in on some of the brokerages. And you know what? Lots of good news across a lot of fronts in real estate. But here's the thing, there's lots of stuff to read in between the lines. I'm going to break it all down for you, the good, the bad, and the ugly. So here's the thing, they just released their Q4 earnings call. And while the headlines say growth, there is a real story that lies a little bit deeper. We're talking improved revenue, a focus on the luxury market, totally great, but also lawsuits and losses, and the market is watching very closely. Now, I'm Isaac Guzman. I'm your strategist, recruiter, and real estate growth expert. And today, here's what we're doing. I'm breaking down what this earning call really means for agents, investors, and industry leaders. Let's jump right in because there's actually a lot of good in this and some stuff that you might not have caught. Let's start with upside because there were a few bright spots. Okay, let's look at revenue real quick. So they actually pulled in $243.3 million in Q4. That's a 13.6% increase year over year. Now, that's not just solid, that's strong, right? Especially in a market with interest rates holding pretty firm and the industry staying pretty tight. Okay. Now, there was also, on the other hand, a net loss shrinkage, which is really good too. So the Q4 net loss, it dropped to 6 million, down from 14.8 million, right? The year prior. That's progress. Now, what about EBITDA? The adjusted EBITDA, which many consider a better indicator of operational health, improved from negative 16.1 million to negative 5.4 million. That's a very meaningful shift toward break-even territory. Now, hold on. Don't stop the video just there because we got more information about that in just a second. Now, here's the thing. Let's talk about cash because it's an important thing for investors as well. And as of December 31st, they're holding about $145 million in cash and equivalents. That's a good sign for financial flexibility. All right. So far, so good. But earnings calls are kind of like listings, right? The pictures don't always tell the full story. Let's talk about some of the shifts they made. Douglas Elliman is doubling down on the luxury market and starting to pay off, frankly, right? That division brought in, and we're talking about what division, Isaac? Development marketing. That division brought in 25.5 million in Q4. That's actually up from that same time last year from 9.5 million that previous year. All right, that's nearly 3x growth. That's great. Average transaction price, it's up to 1.64 million. So this company isn't just chasing like volume, junk volume, right? They're chasing margin, right? So like fewer deals, bigger dollars. That's really good. Cost cutting. They also cut operating expenses by 19.7 million year over year. Now that's excluding certain charges, but still, that's a good positive step in the right direction. They're in a high overhead industry, especially not playing the cloud-based game, right? So they're leaning into high end, and that fits their brand. But also, that strategy can, and this is a challenge that I've seen happen with a lot of people, that can expose you or limit you, I guess, to a narrow market band. Okay. And it's highly competitive up at that upper echelon of price point. Right. And me personally, I prefer stuff that moves faster. Anyways, all right. So let's go ahead and check because now that all the good news is out there, let's check on what this kind of means. What else is in there, right? Because there's still an annual loss. So despite those improvements, though, Douglas Elliman still closed out 2024 with a $76.3 million loss. All right. Now that's up in terms of losses from 42.6 million in 2023. That's a red flag. All right. And a lot of it comes from litigation costs. They spent over 33.3 million on legal expenses in 2024. That's nearly half of their quarterly revenue eaten by lawsuits. Now, that's not very sustainable. And they didn't really get into detail on what those specific cases are, but who knows? Here was the most telling form for me. And this is actually why I ended up kind of looking at this video because someone brought this up. They go, hey, listen, there's lots of good positive numbers. There was actually an agent out there. Why did the stock perform poorly? All right. Because even after this report, the market wasn't feeling very confident, right? Stock dropped 4.09%, closing at $1.64 that day. All right. And that's after trading under $2 per share for most of the past 6 months prior to that. What's the like gotcha here, right? It's that revenue is up, but profit still isn't in sight, really. And what could be worse, depending on what it was, legal exposure is quietly becoming one of their biggest costs. So hopefully that's not a trend, right? But let's figure out what does that mean for agents. Now, if you're an agent at Element or considering making a move, this report offers both optimism and caution, right? So let's go over some pros. Pros, luxury brand focus means higher average order value, right? Is what you kind of want to call it, higher dollar per transaction per deal, right? The company's deep roots in New York and South Florida still attract a certain type of client, which high-end people are looking for, right? And they're making smart cuts, in my eyes, without completely stripping out operations. Now, if they continue making cuts, they might dig into that, but who knows? As of yet, nothing. Now, what are some of the cons? Well, profitability remains a moving target as they start investing, taking bigger losses. Legal risks and executive decisions could impact future support, so we got to keep a really close eye on that. This is just something that I've seen. A narrow luxury focus means more volatility and slower high end cycles. When days on market increase in the average price points, they go way up in the luxury price points, right? So here's the thing you need to ask, and this is any brokerage you're at, whether it's Douglas Elliman or LPT or XYZ, you name it, right? Is your brokerage reinvesting in your growth or are they just keeping the lights on? Because that's the problem. That's the thing that the person who asked me to go over this said, hey, man, like I see losses, even though those things are going well. Like, is that money just, are we ever going to start pushing the envelope and start digging into better? Or are we just going to try to keep the lights on? Douglas Elliman, in my head, is making some smart moves. Some of them are risky, right? They're growing revenue, they're cutting costs, and betting big on luxury, but they're also dealing with serious baggage, okay? Ongoing losses, and the stock is telling a different story than what the earnings slides might say. So let me know what you think, right? Is Element headed for a turnaround, or are they just dressing up the balance sheet for now and kind of seeing how it goes? And if you are a real estate pro and you're looking to build something that you can control, right? I co-lead a community. It's totally free called Agent War Room, where we help agents grow smarter and scale faster. Now, if you go to the link below, you can go ahead and check that out at agentwarroom.com. And if you want to learn more about how you can partner with us at a more intimate level, helping you build your business, we got real estate CEOs. Make sure you go in the description below. Book some one-on-one time with me. I'll see you on the other side. Until then, stay sharp and keep building. See you on the next one.